They told us Cava was the next Chipotle. They told us that selling Mediterranean wellness to office workers was a technology company worth billions. The market bid this thing up to the moon, convinced that the $15 lunch was the new baseline for American existence. But in 2025, it all turned sour. The endless growth narrative slammed into a brick wall of economic reality. The stock cratered, the forecasts were slashed, and the Mediterranean dream turned into a cautionary tale about what happens when you mistake a trend for a revolution. So, how did the golden child of fast casual burn its investors and alienate its base? Let's walk through the wreckage. Cava didn't start in a Silicon Valley incubator or a Manhattan boardroom. It started in the back of a full-service Greek restaurant in Rockville, Maryland, back in 2006 with 3 childhood friends: Ike Grigoropoulos, Ted Zinaristos, and Dimitri Moshovidis. These were sons of Greek immigrants, guys who grew up around the restaurant business. They opened Cava Meze. It was a local sit-down restaurant, and it was good. But the real spark happened when they realized people were obsessed with their dips. We're talking about the crazy feta, the hummus, the tzatziki. So they started packaging the stuff and selling it in local grocery stores. And soon the product had separated from the service. Enter Brett Schulman in 2009. Schulman wasn't a chef, but understood scale. In 2011, they launched Cava Grill. It was the Chipotle model applied to Greek food using an assembly line of food customization. You pick your base, your protein, your dips, your toppings. It was fast, healthy, and critically, it felt premium. The timing was perfect. The early 2010s were the golden age of fast casual. People were tired of burgers and French fries. They wanted stuff like kale and quinoa, and they wanted to feel like they were making good choices, even if they were paying a premium for it. By 2014, Cava was expanding rapidly, but they were impatient to go from a regional favorite to a national powerhouse. Building restaurants one by one is slow. It's painful, and real estate is a nightmare. They needed a shortcut. So, in 2018, they made a bet that would define their future. They bought Zoe's Kitchen. This was a massive move. Zoe's was a struggling chain with over 300 locations. Cava bought them for roughly $300 million. The plan was to take these tired, underperforming Zoe's locations and convert them into high-energy Cava stores. It was a real estate play disguised as an acquisition. And for a while, it looked like a genius move. They swapped the signs, installed the assembly lines, and watched the unit economics explode. They weren't just selling food anymore. They were selling a lifestyle, and the market was ready to buy it. Fast forward to June 2023. The IPO market had gone dry, and tech was struggling. Investors were sitting on their hands. Then came Cava. They went public on the New York Stock Exchange, and the reception was borderline hysterical. They priced the shares at $22. They opened at $42 and closed at $43.78. By the end of the first day, the company was valued at nearly $4.9 billion. That's nearly $5 billion for a chain that, at the time, hadn't even turned a full-year profit, but the narrative was too good to ignore. "It's the next Chipotle" was the phrase you heard on every financial news channel. And Cava played the part perfectly. They talked about digital engagement, about their loyalty program, about technology. They weren't just feeding you, they were connecting with you. Through 2023 and into early 2024, the stock was cooking. They were posting double-digit same-store sales growth. They were opening new units constantly. In August 2024, they rose to $125.38 per share, and continued to rise to over $150 per share by December, fueled by a new grilled steak option that people apparently couldn't get enough of. Everyone was happy. The founders were rich, and the early investors were popping champagne. But beneath the grill, the coals were starting to cool. and they might have known things were cooling down if they'd been reading my newsletter. If you want the best information about things like distressed debt, leveraged finance, and bankruptcies, click the link in the description, sign up, and get the inside scoop on the latest business news. That way you can learn how to see through the kind of actions that might cause problems in the future, like the investors at Cava did. The problem was that investors were paying a multiple. That's figuring out a company's worth based on a multiple of its earnings or revenue. They assumed Cava would conquer every suburb in America without a single hiccup. They assumed that the American consumer had an infinite desire and wallet for $18 grills. But the macroeconomic tides were turning. Inflation had been grinding people down for years. By late 2024, the cracks were starting to show in the broader industry. Other chains were seeing traffic drop too. Chipotle was getting hit. Sweetgreen was struggling to justify its prices. They took action, but Cava thought they were different, so they refused to discount. While other chains were panic launching value meals and 2-for-1 deals to get bodies in the door, Cava held the line. Schulman was adamant. He said they wouldn't get caught in the short-term trap of degrading the brand with discounts. It was an arrogant stance, frankly. It was the kind of confidence you have when your stock chart is up and to the right. They believed they were immune to the economic heat that was burning everyone else. Their customers, they thought, were wealthy enough not to care. And for a while, they were right. Until the fog rolled in. The bill finally came due in 2025. The narrative shifted from unlimited expansion to what the experts started calling the K-shaped economy problem. That's when the rich are doing fine. They're still buying houses, traveling, and still eating at Cava. But the rest of the people who made up the cultural buzz Cava relied on, like younger people, students, entry-level workers, were broke. And when you're broke, you don't spend nearly $20 on a bowl of lentils and grilled chicken. In early 2025, the company started using a phrase that should have terrified investors: macroeconomic fog. Schulman started talking about how difficult it was to see where the consumer was going. Or to put it another way, people were stopping showing up, but they didn't know when they'd be coming back again. Cava had positioned itself as a mass-market brand, but their pricing was strictly premium. And because of that, the ethical disconnect really started to sting. They marketed themselves on inclusivity, on food for everyone, but they were actively taking part in the gentrification of lunch. Added to that, the external world started to fall apart for them too. Tariffs became a major talking point. Running a supply chain dependent on a lot of imported Mediterranean ingredients is risky when global trade wars heat up. Whether they were the main problem or not, the CEO had to admit that tariffs were fueling uncertainty. They started stockpiling equipment just to keep building stores, tying up cash in warehouses because they were terrified of supply chain disruptions. It was a mess. The simple business of selling hummus had become a complex logistical nightmare, fighting against a global trade war and a recessionary consumer, but the stock market was still in denial. For much of early 2025, Cava was still overvalued by 31.9%, with a P/E or price-to-earning ratio, a quick number that tells you how much people are willing to shell out for each dollar of a company's earnings, calculated by taking the stock price and dividing it by earnings per share, of 43.0 times, while the industry average was 21.4 times. They wanted to believe. Then came August. August 13th, 2025 was the day the floor fell out. A day earlier, Cava reported earnings for the second quarter of 2025, and while the headline numbers looked okay, the guidance was a disaster. For the first time since their IPO, they cut their annual sales growth target. missing their consensus revenues figure of a little over $285 million by nearly $9 million. Wall Street hates a guidance cut. It signals that management has lost control of the kitchen. Having already dropped by 35.5% in the previous 3 months, way more than the industry's average decline of around 10%, the stock plummeted even further. It was the biggest single-day fall on record for the company, dropping by 23%. It wasn't just fog anymore. The cause was clear. Younger diners were pulling back. The demographic of 25 to 35-year-olds that basically invented the bowl lifestyle simply couldn't afford it anymore. They were trading down, going to the grocery store, or going to fast food chains that actually offered value menus. Cava's refusal to discount, which looked like strength in 2024, looked like stubbornness in 2025. The analysts turned vicious. They started calling the sector bloated fast dining. The Chipotle of Mediterranean comparison started to look less like a promise and more like a curse, and it wasn't over. You would think after the August disaster, management would pivot, maybe introduce a cheaper option and pause the aggressive expansion. But Cava kept building and kept refusing to discount their meals. They were running on a strategy of, if we build it, they will come. But they weren't. In November, Cava announced yet another cut to their sales forecast, leading to another 4%, reaching 10% after hours. The third quarter results showed same-store sales growth slowing significantly. The market realized that Cava wasn't a tech stock. It wasn't a software company with infinite margins. It was a restaurant chain that sold perishable vegetables to people who were increasingly worried about their own job security. And to make things even worse, there was a sense of cultural fatigue brewing. For years, Cava had been the cool office lunch. But when you become the symbol of the overpriced desk food, the cool factor evaporates. It becomes a symbol of the corporate grind that people are trying to escape instead. The K-shaped problem meant that Cava was increasingly relying on a smaller and smaller slice of the population. They were becoming a niche luxury brand for the upper middle class, rather than the mass market revolution they promised at the IPO. And while Cava was holding its nose at discounts, places like Chili's and McDonald's were winning the value war. They understood that in 2025, value wasn't a dirty word. It was a survival strategy. Cava's management, sitting in their ivory restaurant of brand integrity, missed that and treated their pricing power as a permanent asset, when it was really just a temporary privilege granted by a stimulus-fueled economy. When the stimulus dried up, so did the pricing power. Cava isn't going bankrupt. Let's be clear about that. They are still opening restaurants. They are still profitable. But the company is currently trading way down from its highs. Their valuation has compressed. At the time of making this video, their market cap is $6.5 billion, and their shares are $56.03 each. So higher than they were at their IPO, but a huge drop from their 52-week high of $150.88. Who knows where it will be when you're watching this? They are being forced to act like a normal restaurant company now, not a tech darling, and that transition is painful. It means they have to care about pennies, and they have to worry about the price of chickpeas and olive oil in a way they didn't before. It also means they have to figure out how to get a 24-year-old to walk in the door again when that 24-year-old is struggling to pay rent. We are seeing the bloated fast dining sector finally deflate. It turns out you can't leverage your way to popularity forever. The lesson of Cava's bad year isn't just about the price of hummus. It's about the cost of hubris. It's about the dangerous assumption that a brand can transcend economics, and Wall Street wanted to believe that Cava was special. But in the restaurant business, if the food is too expensive, the line gets shorter. It's really that simple. The dips are still good, But the stock? That's a much harder pill to swallow. If you liked learning about the ingredients behind this struggling business, be sure that you can get more where that came from by clicking on one of the videos above. Thanks for watching.